Very quickly, I just wanted to review some of our recently posted content on the webinars page and on YouTube. We posted 7 videos this week alone, better ways to find spreads or condors on high-price stocks using the PowerOptions tools, criteria for diagonal spreads, and bull put credit spreads. 2 that are very similar, picking the right call to buy, and then we did an additional presentation to clarify some of those points. Is there a proper delta to buy a call? We talked about the stock repair strategy last week, not just what it was, but then how to manage it as you go forward. We talked a little while ago about managing a short strangle and a basic introduction into iron condor positions, plus other videos that were posted in the last 5 days, when to stop managing a naked put, what is a good number of options trades, and evaluating strike price for naked put positions as well. So you can check that out on YouTube. Just go to Power Options, go to our videos, and scroll through those where you can search for specific topics as well. And something new, in the playlist section of Power Options YouTube channel, we've updated 2 of the playlists, the covered calls, strategy approach and management, and selling naked or cash secured puts. These 2 new playlists are all videos from just the last 2 years, all recent videos, all recent discussion. It goes through discussion of the strategy, picking the proper strike price for those strategies, criteria you might use in a search to identify good positions there as well. Most of the videos are under 30 minutes. A couple of the ones in the selling naked or cash secured puts playlist are about 35 to 32 minutes, but most of them there are under 15 minutes as well. And we're going to put out more playlists there so it's easier for everyone to navigate for a strategy, credit spreads, debit spreads, calendar call, poor man's covered call, buying call options, buying put options, hedges on the portfolio, and much, much more. So that's all going to be available. Just a new feature that's available on YouTube so you can see more content in a direct fashion, updated webinars, recent webinars in the different playlists. We'll have that filled out for you next week. All right, now we want to get to Salvatore's question that he emailed in this morning. Okay, so this is one of the age-old questions in 2 forms that Salvatore presented to me today. And rules for rolling covered calls. When should I roll the covered call? When should I let it just expire worthless? Should I let it just expire worthless and wait to the next day to sell, wait till Monday, I should say, to sell the new call? Pretty much the direct question was, what are the general rules for allowing an option to expire or for rolling it? Well, the basic guidelines that Ernie and I look for is that if we're in a covered call or cash secured naked put, if the time value of our existing call that we're in has dropped less than, say, 0.5% of the time value, we may look to roll the position. Or if we've made 80 to 85% of the expected profit, I sold a call for $1 10 days ago, I could buy it back for 15 or 10 cents today, might go ahead and do that and then look for the roll opportunity. An age-old question, is it better to roll on Thursday if your option is out of the money and only has a 5 or 10 cent buyback? It's better to roll on Friday, or is it better to let it expire and then look for a new call on Monday or later? Now, here's a current position I'm in for the radioactive trading approach. It is a married put position, but I'm holding an out-of-the-money call that expired today on Ally Financial. I bought the stock a while ago at $45.93. I have a January 55 put that I paid about $10.35 for. We've been selling calls and making adjustments on this position following the rules in the blueprint. But as it relates to our topic right now, I am holding a September 17th expiration. It expired worthless today, 55 strike, and Ally's at 52.21. It was down as low as $51. I could have bought it back for 2 cents on Monday, I believe, but I didn't. The buyback cost is essentially nothing. The current midpoint is 1 cent as we are getting close to the end of the day. Time value is at 0%. I've made well over 80% of what I expected to make on this sold call with no time value left. This would have been when I would have looked to roll the call earlier. I would have done it Monday or Tuesday perhaps, but I didn't. Now, why haven't I closed or rolled following those guidelines I just mentioned? I could have rolled to the October 55 call today. It's roughly at about 82 cents. This would have given me a bulletproof position. I now have no risk on Ally Financial with protection out to January, still 126 days to go. Still going to collect another dividend, potentially 2. I've increased my positive upside profit on this position by selling the new call if I had rolled. But like a diagonal in this structure, the max profit tapers off once you start to cross the short call strike price. This is still a better position than I'm in right now. So why haven't I rolled to having the capped gain on this married put for October expiration? And the reason why is because I have earnings coming out before October 15th. I might not want to have a capped gain if I'm bullish on Ally Financial's earnings, and I think the stock has more room to run above the 55 strike. That's the reason why I haven't rolled this position yet. I can actually move the put in if I wanted to, following the rules in the blueprint, and have a bulletproof position. If I moved it from January to, say, November and kept the same strike, I'd get a credit greater than 82 cents to do that, and I'd have no risk with unlimited upside. But that's just a caveat. That doesn't answer Salvatore's question. It answers the reason why one might not do it if the rules are achieved. And that was part of my initial answer. You have 80% or more of the expected premium that you originally received, whether you were talking about selling a naked put, cash secured put, or covered call position that's out of the money and we're getting closer to expiration. That's when we usually look to do that. We might consider rolling at that time. We've made 80% of what we expected, and our time value is less than, say, 0.5%. On a weekly, I might use a lower value, say less than 0.3%, because I might have only collected 0.7% for the weekly series. When might I not do that? If I have an event coming up, a known event, such as earnings or something along those lines, I might want to add a put just to my stock position or do a collar spread if you're doing covered calls to have the downside protection in case the earnings disappoint. Or if the stock was too far below my break even. If Ally was trading at 51 or at $50 per share, and I bought back that 55 call for 1 cent, do I want to sell a 50 if my cost basis is still 53? Do I want to sell a 52.50 call, get maybe 60 cents or 20 cents for it if my cost basis is 54? Maybe not. I'm hedging the position. I'm lowering my cost basis, but I don't want to necessarily risk getting assigned at a loss because the stock has taken a fall. Well, let's get right to the meat and potatoes of the second part of the question. Is it better to close and roll it forward on, say, Thursday or Friday, or wait for it to go worthless, go through today's expiration at 4 o'clock, and set up another short call the following Monday? Would the premium proceeds on Thursday or expiration Friday be worth more than on the following Monday? The general answer to that is yes. It's probably better to roll on Thursday or Friday. Especially, and part of my response to him, is that if you decided to continue to roll already, if we're in a long-term holding, Salvatore, you want to continue just selling premium against it out of the money to mimic a dividend-like premium, yes, you're probably going to want to roll Thursday or Friday, assuming that you've made 80, 85, 90% of what you expected to make on the original call, or the time value has dropped, to less than 0.5% or maybe a little bit lower, especially if you're looking at weekly options. But again, if the stock is not near desired strike price, it fell too far, it's below our break even, I might just let it expire and then look for a new opportunity later on if I'm still bullish on the stock going forward. But let's take a quick look. I know it's one of those things where I always say, we're going to take a look at this, but one example does not the market make. Okay? And what do I mean by that? On Thursday, September 2nd, Apple was trading at 153.65. So let's say the previous week, or that Monday, August 29th, August 28th, we had sold the 157.5 call, roughly 4 points out of the money, maybe got 30 or 40 cents. On Thursday, it's essentially down to nothing. It's at a 5-cent buyback cost. Apple's at 153.65. The 10th of September, 157.50 strike, going 1 week out, staying roughly 4 points out of the money, is at 68 cents. So in this case, I'd have a positive premium in of 63 cents. Now, what's really interesting is that the next day, Friday, September 3rd, Apple goes up about 70 cents. My September 3rd 157.5 buyback is still only 5 cents, but the 10th of September 157.5 call dropped to 52 cents even though the stock went up. Could have been a change in volatility, a little bit of time decay in that case. but we'd only be getting a net positive of 47 cents by rolling on Friday. In this case, Thursday looks best. Now, let's say we let it expire. Our 157.5 call expires. We kept that whole 30 cents. We didn't put anything to buy it back. But on Monday, Apple jumps up a couple points and it's trading at 156.69. Now, the 157.5 call is at 93 cents. But is that a fair comparison? Because in these two examples, we were about 3 points, 320, almost 4 points out of the money. So at 156.69, to be a fair comparison, 3 days later, from Friday's expiration on the 3rd to Tuesday, September 7th, remember we lost Monday the 6th due to Labor Day holiday, so we could trade on Tuesday, September 7th, but the call that's 3 points, 3.5 points, 4 points out of the money is the 160, and it's only trading at 30 cents. That's a significant decline from the 52 cents where it was on Friday, and about half, more than half, from the 68 cents it was on Thursday. Now let's take that forward one more time. What happens the next week? On Thursday, September 9th, Apple's still around the same price, 154.07. Our 10th of September 157.5 call could now be bought back at 3 cents, and the 17th September 157.50 is at 114. Why is it so much higher than it was the week before? I'm going to answer that in a minute. Friday, September 10th, Apple's at 148.97. It dropped 4%. This was because of that ruling with the App Store and against Fortnite/Epic, and you saw Spotify go up because of this ruling, but Apple fell. Of course, the 157.5 call is going to be nothing. It's 1 cent to buy it back. It's in our wheelhouse of when we would look to roll. But I can't go to the 157.50 because that's now 10 points out of the money. Okay, 9, a little bit less than 9, but that's still too much for our comparison. But the 4 point, 3.4 point out of the money 152.5 calls at 124. Now this is an increase. It's been buoyed up by implied volatility because of the decline in the ruling, but it's still 4 points, roughly 3.5 points out of the money where we were in our other example, and the price is relatively high. We're getting some good implied volatility. That's why these were higher here, because the event was known and was going to, the September 17th expiration cycle was going to be affected by that ruling that was supposed to come out on the 10th. But stock's still around the same price, 149.55. On Monday, September 13th, that 152.5 call is at 80 cents. The stock moved up 60 cents. We lost 2 days effectively of time premium, Sunday and Saturday, and partial Monday when we were able to get the price for this. But on Monday, September 17th, it's down to 80 cents from 124. Yes, some implied volatility settled, but you lost about 30% of the premium. And the 155 call, which is technically, I mean, this is 3 points out of the money, but this is a little bit more, closer to 5 points out of the money. It's only at 39 cents. So what does that really tell us? Well, it tells us in both cases, we saw on Monday that the same range out of the money, the call declined. From Friday, September 3rd to Tuesday, September 7th, the 157.5 call for 10th of September expiration was at 52 cents. Even with a stock change on Monday, the option that was 3.5, 4 points out of the money was only down to 30 cents. We gained 230 on the stock, but again, that's a fair comparison. We gave up 20 or 30 cents in those 2 days. Okay, we gave up, 22 cents on those 2 days. Friday, September 10th to Monday, September 13th, with the stock falling after the event. On Friday, that 152 call was at 123. On Monday, it was at 80 cents. And the stock had just moved up a little bit, only 60 cents, but you still lost 43 cents on the call premium from Friday to Monday. And this goes along with our expected decay that we'd see, especially for a weekly option. When you're looking at the option chain, or if you're looking on a covered call screen, you can link to the calculators for the more information button and then go to the Black-Scholes calculator. Oh, let me clear out those drawings, folks. Sorry about that. And what do we expect to see? Okay, well, today, what we're looking at is September 24th expiration. This is right after the market closed. Stock's trading at 146, so I'm staying 4 points out of the money to the 150 strike for September 24th. The option price today was at 52.53 cents when I ran the search. And as you can see, the system doesn't know that this is necessarily a Saturday or a Sunday. It's just expecting the decay. We go down to 44, 34, 24. On the 20th, the expected value, if nothing changed, volatility stays the same. We know there's going to be price fluctuations, but it's expecting over that 2-day time period to drop from 53 cents down to 24 on the theoretical pricing models. And here we are here, Monday, September 20th. After the weekend, the price expected to open roughly around 25 or 24 cents. If there's no change in implied volatility, 0.2293, the stock price stays right around 146. That's extremely significant, Salvatore, when we're talking about using weekly options. It is better to roll on a Thursday or a Friday if your plan is to continue rolling and to continue selling against the stock that you have that's a long-term hold and you're trying to get weekly income, because you may be giving up 30 or 40% in just that 2 days of time value in most situations. Now, again, this is a specific example. It had some flux in the stock price over the time that we looked. But if my game plan, Salvatore, is to continue to roll the position, continue to sell against it, if I've hit expiration, or I'm nearing expiration, the time value remaining is less than 0.5%, or we've made 85, 90% of what we expected to make on the position, I'd consider rolling at that time to the next cycle on Thursday or on Friday, rather than wait to Monday's expiration. Okay, Salvatore is a follow-up question, of course, and that's perfectly fine. So let's navigate now over to Power Options. Salvatore's follow-up question, where does one find the remaining percentage time value? Well, there's 2 places. First, I could just go to the chain. And of course, I'm just going to go to the call chain, Salvatore. We're talking about calls, but you could select it on the puts as well. And you see here, I've selected the percent time value midpoint as one of my columns on the chain. So I'm interested in what is my 157.50. Well, we know it's 0. What are my time values going out? We looked at the 150. It's only at a 0.4% time value. Now, this is important. I had mentioned that one of the rules, Salvatore, when we're analyzing these positions, is that when we have less than 1% of time premium, you heard me say that first, or you've heard me maybe say that in other webinars, that's when all we had available were the monthly options. We didn't have weeklies, meaning that if I sold a monthly at or out of the money option 25, 30 days away, I likely would have been collecting 3%, 2.5%, maybe 4% of premium on the position. So when it went down to 1% or a little bit lower, I've made most of what I expected to make on the position, especially if I'm 4 or 5 days to go to expiration. Rather than just waiting for that last 0.7, 0.8%, I might as well just roll it and get to the other 3 or 4% that's standing further out in time, as we just saw with a weekly relationship rather than a monthly. But if you are selling, say, out of the money calls week by week on a stock that you owned for a small dividend-like income of 54, 55 cents for our 24th of September 150 strike, we're only getting 0.4% of premium. If you're only getting 0.5 or 0.4% of time premium using out of the money weeklies just to continue, to generate dividend-like income, you'd probably want this time value to go down to 0.1%. Right? Doesn't make sense if I only collected 0.4 to close it if it's at 0.5. Or if I sold 0.5 to buy it back when it's at 0.4. I have to keep in mind what I originally collected for the time value. And how would I do that? Well, I'd put it into the notes when I entered my trade, into the portfolio tool of what my original time premium was. Then I'd set an alert to be notified. Let's see here. Let me just take this position. We're going to add an option leg very quickly. I'm going to show you something else. So we're going to sell today's 55 at 48 cents. And we did that back here in August. So let's just say the 11th. Why not? Okay. So now I'm going to have a collar And as I mentioned, what I would have done is put an alert here. So in my notes columns, I would have set a note here that when I sold it, only received 0.4% time value. Will look to close if is less than 0.1%. Okay, so well, now I have that in there as part of my trading plan, Salvatore, and my note taking here in the portfolio. But what I also would have done when I sold this call or in other positions that I would have entered, I would have gone into the alerts column. You see I have one there for Barry. It's below 64. And I'd set an alert here to be noticed if my time value on the call is less than, let's say, 0.1%. Or if my option premium is less than 0.05. Okay, and that's sort of a benefit. I mean, I'm getting a value out of it, but that lets me know that I want to take action. So I'm going to go ahead and save the alerts. And sure enough, we're triggered. The option leg is less than 0.5 cents, less than 5 cents, excuse me. And the time value is less than 0.1% because it just expired today. But as you know, Salvatore, when I'm looking to evaluate adjustments, rollout opportunities, or more, I'm tracking my positions in the portfolio. And if you're in a covered call, a naked put, a collar spread such as this, a married put with a short call, when I go to position actions and then position analysis from the trade, you get the original breakdown of the position showing you where you stand right now, maximum risk remaining. This doesn't include all of the adjustments that I did where the risk is only 80 cents here to the downside. And as I mentioned, we could bulletproof. What I wanted to show you, of course, is right here. When you're evaluating in the rollout opportunities, it shows you the time value left in price. And if you set the alert, Salvatore, in your portfolio through various covered calls or cash secured naked puts to be notified when the time value is, say, less than 0.2% or 0.1%, or if you've made 85% profit on the call, that's an alert I could set as well. When the alert triggers in your portfolio, linked to position analysis, you can see immediately the time value left in price. And then, of course, as always, if they're available, you can scroll down further on the analysis page, see your current liquidation value versus future expiration. If there's any rollout opportunities here, they will show for you. No rollout opportunities appear, just click on the profit and loss chart. As we always do in the presentation, Salvatore, you could do the adjustment manually to see what the new effect would be on your position.